All right, so again, if you just joined us, this is a part 2 follow-on from the webinar that we did a few weeks ago. We were pleasingly surprised at the amount of questions that we had, and it ended up that we weren't able to get through all of the content. So we put together this second part. If for some reason you did not attend the first part of this webinar, you can watch that on LedgerGurus' YouTube channel. We talked heavily around company structures, state and local tax, but we just got an overwhelming amount of questions on that. And today we'll be following up and talking more around due diligence and what happens from a tax perspective when you go and sell your company. As with last time, if you have questions, feel free to ask them in the question and answer manager, which is a little in-app thing that you can click on at the bottom of your Zoom screen. You're also welcome to put in questions on the chat if you'd like to. I'm Stephen Brown. I'm the CEO of LedgerGurus, and I'll be moderating. With me, I have Heather Allen and Steve DeWitt from Tanner, and I will turn it over to you two to pick up the conversation.
Great, thank you. Yeah, again, hopefully kind of, getting back together to finish the conversation that we left off a few weeks ago. These are some quick bios for me and Steve, and then also at the end we'll have some contact information we'll put up. So as additional questions or anything else pops up after, please feel free to reach out to us. But we're going to just jump right in where we left off last time. And the next section that we really wanted to talk through and what we see a lot of our clients, growing companies, what they're getting ready for is an eventual exit. So it's never too early to start thinking about that and to know what's going to come up in due diligence, in the process, what buyers and their advisors are going to be asking for. You don't ever want to get surprised by that. So having these things in the back of your mind as you're starting your company, as you're growing, even if that's a couple years out, that's really the best time, to start thinking about this. So some of the items we wanted to point out are that when you get into this potential, transaction phase, the LOI that you get is what really sets the stage, right? So for large items that you are wanting to negotiate, doing that before signing the LOI is you're setting yourself up in the best position so that you can, there'll still be negotiations after for, some of the smaller pieces, but as Steve's going to get into in a few minutes, things like, is this an asset sale or is this a stock sale, right? Negotiating those large items before you sign the LOI will really set the stage and help the process go a lot smoother. Another item you want to do is to calculate your own exposure before the buyer does, right? Just being prepared for any of those items that you think are out there so that you aren't surprised, if they bring up something that you haven't thought about before. So getting your arms around all those state and local tax items that we talked about last time, any other, just exposure areas that, risk management, and maybe there are items that, aren't a big deal and that's why you hadn't taken a certain position, the years before that, but just having those on your internal checklist and being prepared for those before a buyer asks helps the process go a lot more smoothly. Another item to look at is all your federal and state income tax returns. So the positions you've taken on state apportionment, nexus considerations for remote employees or independent contractors, or location of your inventory, right? Some of those items that we talked about last time that might even be out of your control. If you're using Amazon and they're warehousing your inventory, you don't have control over where that's going to be. But that may be creating state nexus issues for you. So those are the types of things to have your arms around and understand, what you expect a buyer might ask. Maybe they won't ask, but then if they do, it won't be a surprise to you later. And then lastly, this isn't something that we see a lot of, but always comes up on a due diligence checklist, is if you've had any previous audits, income tax or sales tax, buyer's always going to ask about that, or any that are in process, as well as any statute extensions. So if anyone has had the experience of going through an IRS audit, many times the IRS is behind. And so when they start the audit, they immediately ask you to sign a statute extension to give them time to get through the audit. A buyer is going to want to be aware of any of those agreements that are out there, just for any pending liabilities that they may be taking over with the company. Stephen, I'll just stop there for 1 minute if there's anything that's come up, regarding that slide, or let me know if I'm good to move on.
I just want you to explain one concept. What is LOI stand for, and what exactly is that?
Yes, thank you for that. So LOI stands for letter of intent. So that is generally the first type of binding agreement that is entered into in a transaction. So it can be, maybe just a couple pages long, but it's the general letter of intent signed by the potential buyer and the seller, just very large or high level overview of what the transaction, how it may be structured, even items such as, this is the price that we're starting from. There may be negotiations or EBITDA calculations or things after that may adjust that, but it really sets the general terms that transaction is going to follow, and generally has exclusivity with it. So before you sign an LOI, you may be talking to multiple buyers, or working with an agent to vet out some different offers, but you're generally only under one LOI at a time, because then that buyer wants exclusivity as you're working through the process before closing the deal.
Awesome. Thanks for that explanation. No questions at this time, so let's keep going.
Okay, great. Okay, then on the non-income tax side, so sales tax, that's a very big one. We see that come up all the time. So going back to what we talked about a couple of weeks ago, really getting your sales tax processes set up correctly at the beginning is what's going to be most helpful when you get to a potential exit at the end. If that hasn't happened, then doing your own internal analysis, getting an expert involved to really look at your nexus issues, if there are states where you haven't been filing and do have nexus, or taxability of the products, and looking at all of your services and products, whether those should have been taxed or not. Doing those calculations internally needs to be done. Just if you don't do that, then you're really just kind of at the mercy of whatever the buyer calculates as your exposure. And buyer's going to want to have a calculation be as large as possible of that exposure to increase any type of escrow or holdbacks, right? So having some internal calculations on your own that at least you can negotiate then with the buyer is going to be really helpful. Payroll tax, the biggest issue we've seen the last few years is remote workers, right? With COVID, and people have either moved away to somewhere that they wanted to live before, now that they can work remote, or in order to find, those certain individuals with certain skills, you're hiring people in remote locations. So just being aware of any payroll tax exposure. And that includes, I would throw in independent contractors, right? You can't just put somebody on a 1099 and then, avoid any type of payroll tax exposure. Sometimes a buyer, they're going to get very granular on, is this really an employee that should have been on a W-2, or, are they okay to be on a 1099 and really considered an independent contractor? Property tax, this definitely isn't my area of expertise, but it always comes up on a due diligence checklist. So, just looking at any of those owned or leased properties and making sure all those filings are up to date. There can also be some transfer taxes and things that apply upon closing a deal. So you want to have generally an attorney making sure they're looking at all of that. And then lastly, I've actually seen some billboards around the Salt Lake area about this, but unclaimed property, right? Just on the state website, just double checking anything, connected to the company for uncashed payroll checks, gift cards, AR credits, and just making sure that gets cleaned up.
Yeah, and I would add to what you've outlined here. We saw a lot of our customers. There's a lot of sales of e-commerce businesses through the beginning of last year. It's slowed down significantly since, but a lot of this stuff goes into how you run your finance and accounting day to day. There was a number of businesses that we saw where they deprioritized what we had advised them. And then all of a sudden, when they went to the sale, the buyer and the accounting firms and lawyers that were supporting the buyer all of a sudden put a lot of emphasis on these things. And what ended up happening in some cases was, the price gets impacted. One of the things we see that doesn't really affect, it doesn't affect tax, but one I would add here is inventory. So if you don't your inventory counts very frequently, you may have inaccurate inventory amounts that are accounted for. Your loss of inventory, your leakage. There's the different things that will happen. And it's, from a tax standpoint, it's okay to kind of like drag that out. But if you decide to take that during the sale, that will usually require a one-time adjustment that usually affects the price of the deal. So on top of everything else here, I would say all of the things that your accountant, whether it's in-house or working with a partner like us that's telling you to do, remember that those things will come to fruition at the time of a deal, and you will pay for that, not only in terms of the work that needs to get done, but oftentimes in the price of the sale of your business.
Yeah, I absolutely agree. You're right. That comes down, if you're having to push a big adjustment through that lowers your EBITDA, maybe the multiple hasn't changed, but now your overall price has just been lowered. And even some of the intangible consequences of just lowering confidence, right? As these things come out through due diligence, if the buyer starts to have their confidence, in the seller's teams and processes eroded, any of those cracks in the system just are there then to be exploited, and we've seen deals get soured, right, by some of these issues coming up later.
I had let me see if I can get Diana. She raised her hand. Diana, you can let's see if you want to ask your question over the audio. You're able to, but you'll need to unmute yourself to do so. All right, Diana, if you have that question, maybe we could wait till a break, or feel free to write it in the question and answer manager. But for now, let's keep going. Okay,
great. Well, I'm going to pass over to Steve. Going to jump into some pretty technical issues, but talking about the different types of sales that you can be faced with on that exit.
All right, yeah, thanks, Heather. As you're going along and you're in the due diligence process, and you've built up your really successful business, and you're getting ready to sell it to a potential buyer. A lot of the times, the question that comes up, or the question that's asked of us, is, hey, should I sell the assets of my business, or should I sell the stock that I own? And each of those different types of sales structures does come with its own pros and cons. And they have different tax treatments and different legal treatments to the buyer and also to the seller. And so I'm going to outline a little bit of some of the differences that arise. And also, if you were part of the initial presentation that we had, we talked about the different types of entity structures. And so that also plays a role in how you sell your business and what type of entity that you have, because there are different treatments depending upon the type of entity, as well as if you sell stock or sell assets. So first we'll cover the proceeds that you're going to receive in your sale. So when you have an asset sale, generally the proceeds are received by the company itself, and then those proceeds are allocated to the different assets that the company owns. You'll usually go through a negotiation with the buyer and have a purchase price allocation to assign different fair market values to the assets that are being purchased. So, if you go through your balance sheet, you're going to have cash and AR, inventory, fixed assets. And then generally you're going to have this big intangible asset that's not on your books, but that's what the buyer is really trying to get at, is this goodwill that you've generated internally over the years, where a lot of the purchase price is also going to be allocated, depending upon the type of business that you have. And then that purchase price is allocated to those assets. And then you look at your tax basis, or what you paid for those assets, and you calculate a gain on each of the assets. And then that gain is, depending upon the type of entity you have, that gain would be passed through to the owners if you have an S Corp, or if you have a partnership. If you have a C Corp, then that gain is recognized at the C Corp level, and taxes paid by the C Corp for any gain that's recognized on the sale of those assets. And then the taxes paid by the C Corp, and then any residual cash that's left can be distributed out to the owners of the C Corp, where taxes then again paid. So that's kind of the downside of an asset sale in a C Corp if you want to get the cash out to the owners. There's the two layers of tax that you're going to be dealing with dividends and with capital gain treatment, and then also the tax that's paid at the C Corp level. However, at the partnership or S Corp level, you just have the one layer of tax. And generally that layer of tax is going to be a mixture of capital gain and ordinary gain, depending upon how the purchase price was allocated to the various assets. If you have ordinary type assets like inventory or fixed assets that have been depreciated, then you could have ordinary income arising from the sale of those assets. And then any kind of goodwill that you've generated internally would be treated as a capital gain to the owners. For a stock sale, it's a little bit different. If you own a C Corp and you sell your stock, then generally that's just going to be a capital gain to the owners of the stock, similar to like if you just own Apple stock or Microsoft stock or something like that, and you go and sell that, you'll have capital gain treatment. As long as you've been holding it a year or more, it'll be a long-term capital gain. If it's less than a year, then it'll be a short-term capital gain, which has significantly higher rates. And like I said, with a partnership, it would be a mixture of capital gain or ordinary gain. And that would also apply if you sell your LLC units. That's something important to remember. If you're in a partnership and you sell your units, it's still treated as an asset sale for tax purposes. And there is a potential to have some ordinary gain to recognize that will be taxed at those higher rates versus capital gain. And so there still is a little bit of a mixture on that. That's something that kind of surprises people sometimes when they sell their LLC interests, that it's not all capital gain. It's still a function of the underlying assets that are inside of that partnership when you sell. So I'll pause there on the treatment of proceeds and how those and the nature of the gains that happen for the seller. If there's any questions on that, or Stephen, if you have anything you want to follow up on there.
Yeah, I mean, I think this kind of goes back to part one of our webinar, but Steve, correct me if I'm wrong, we spent a lot of time on the setup of the structure, because a lot of that gets dictated, how things are treated from a tax perspective are very heavily influenced by how you set things up in the beginning. Would you say that's an accurate way to summarize what we've said here? Yes, definitely. The way you set it up is going to dictate a lot of what happens down the road when you sell your business. And so it's really important, with, your goals in mind and, the future prospects that you have, that you set it up how you want to help minimize any potential taxes that could arise down the road when you sell the business. What are the biggest issues you've seen as your customers have come to a sale of their business, that, things that you're like, oh man, I wish, they're asking a question that they should have addressed years ago? What are the things that you would say are the most common issues or common questions that could be addressed before they get to that point? I think
recently, we see more of, maybe issues with 1202 stock. We talked a little about that in our last meeting, where, if you had started up as a C Corp and had that 5-year holding period, there's potential to exclude all or part of the gain under section 1202. And so people not realizing that potential, that avenue is available to you. And then they get to the point where, they're at they're still a partnership or an S Corp, and, they're looking to sell their business. That opportunity is pretty much closed to them at that point. So that's something to consider, when you're first starting up, especially because you have that 5-year holding period that you need to worry about. And I think too, the sale of a partnership interest, where you have potential for both ordinary recapture or ordinary gain and capital gain. That's some issue that could come up as well, that we've seen, where people aren't aware of that mixture of gain that can be there. I don't know, Heather, anything you want to add on to that?
I would just add, I think the S Corp election, we talked about this a little bit last time, but the biggest potential for savings there is to save self-employment tax, which can be, that may be enough to make the S Corp election be the right answer. But on a sale, an S Corp is harder to deal with, and you're pretty much limiting yourself to just do an asset sale, just because the buyer, if they're buying, they may not be able to buy the stock. They definitely can't keep it in an S Corp. So that sometimes can pose some additional challenges to work through. I believe Steve mentioned last time, there is some restructuring that can happen around an S Corp to make that deal still work. But I think we hear from, a lot of clients, we pick up a few years into it, maybe then they're a couple of years away from an exit, is, oh man, I wish I would have had this conversation before I made that S election, just to make sure I understood.
All right, we got some questions now. Let's start with, would it be possible to go back to the 1202 slide and just kind of briefly reiterate what the 1202 potential is?
Yes. Sorry if I'm going to give anybody motion sickness by flipping back really quick to find that slide. Let's get back to the
you just, there you are.
Right there. Steve, do you want to jump in and give that overview real quick?
Yeah. So 1202, section 1202 is a code section in the Internal Revenue Code that's been around for quite a while. It's mostly come into vogue in the last, 5 to 10 years, mostly because of a change that was made about, 2010, 2011. So almost what year are we in? Yeah, so about 10, 12 years ago, where if your stock qualifies as qualified small business stock, you have the potential to exclude 100% of the gain on that stock when you sell it. There are various requirements that need to be met in order to have it be considered qualified small business stock. One of them is it has to be, originally issued from a domestic C corporation. That's probably the most important aspect of it. There's a 5-year holding period. So you have to have the stock issued to you and then hold on to it for 5 years before you sell it. And then when the stock is issued to you, the gross assets of the company have to be under $50 million, hence the small business stock nomenclature that's given to it. And it only applies to certain types of business activities. It's actually pretty broad. There's very narrow exceptions to the types of activities that are included. E-commerce is one that is included in the definition of a qualified business. But generally professions such as like legal services or accounting services, anything where like individuals are performing most of the services, a lot of those are excluded from being qualified for the small business stock exclusion. And there's also some rules related to redemptions that I don't think we really need to get into too technical detail. But the biggest things are, it's got to be a C Corp, you got to hold for 5 years. And when you get the stock, the business has to be under $50 million and be a qualified business. Generally, if you meet all those requirements, hold on to your stock for 5 years and then sell it, you're able to have the gain completely excluded from taxation. So that'll save you both, a 20% capital gain tax, a 3.8% net investment income tax, and generally most states conform to Section 1202, and so usually you save state tax as well. I know Utah is one that conforms. I don't think California does, from what I remember. So with Utah, you're looking at saving about 28.8% tax on that gain if you're able to meet all those requirements. So that's a big benefit of structuring as a C corp if you're looking for a sale down the road.
So that you trade off having to potentially pay more taxes during the operations of the C corp with being able to keep more of the proceeds during the sale.
Exactly. Yeah. Like if you have a profitable business and you're trying to get cash out of that business, you're going to be subject to 2 layers of tax because the company's going to be paying tax, and then you're going to be, distributing dividends out, which are also generally taxable. There's ways around that. Maybe you increase wages, but then that's still higher taxes that you're paying on those wages. Where if you're a partnership or an S corp and you're profitable, you're able to only have 1 layer of tax, and so that previously taxed income, those profits can be distributed tax free because you've already paid tax on them. And so it kind of cuts both ways, and it just depends upon what your goals and what you're looking for your business and how you want to structure it.
Okay. Follow-up question on this topic. RJ said it sounds like he's selling a single member LLC treated as a C corp since 2013. What do I need to get the 1202 tax benefit? Do I need to have issued the stock years before the sale?
So if it's an LLC,
Go ahead, Heather.
Okay, and if it's an LLC that made a C corp election in 2013, you're deemed to have issued that stock in 2013. So you have been holding C corp stock since then. So you would just be looking at these other tests, right? What was gross assets? If you made the C corp election right upon startup, then you shouldn't have an issue at all with the gross assets. If you made that, maybe the LLC was formed a couple of years earlier, then you made the C election in 2013. You'd have to look at value at that time to make sure you're under the $50 million. And then Steve had kind of touched on the redemption issues, but just what else has happened with your cap table over those last 10 years to make sure there's nothing else that would have, potentially disqualified it. But an LLC making a C corp election is deemed to have issued stock on the day that election was made.
Yeah, and one thing I should note, I said exclude all of the gain. There is a limitation on that. The first bullet point there, I think I skipped over that, but there is a $10 million. The greater $10 million are 10 times your basis upon the sale. So generally you're looking at $10 million, assuming you have a very low basis in your stock. And so the first $10 million of sale, that piece would be excluded. Now, if it's something where you converted your LLC over to a C corporation, that 10 times basis number actually becomes a bigger avenue to exclude even more gain, because the basis they look at is the fair market value of those assets on the date you converted your LLC. So if your business was worth $10 million on the date that you converted, then you could exclude up to $10 million or up to $100 million of gain upon that gain from the date you converted until the date you sold, because that like Heather said, that pre-conversion gain is still not eligible. You'd still be taxed on that, but everything from the date you converted and any increase from there is what's able to be excluded. And so there's potential to exclude even more than that $10 million if the fair value of your assets are even higher on that date that you converted. Sorry, that was kind of jumbled together, but in the long run, if you convert over, there's potential to exclude even more because you have a higher basis that you're looking at.
And that exclusion is per shareholder. So if maybe 2 spouses own the company, they each have that potential for the $10 million or 10 times basis exclusion. So There's a lot of planning opportunities as well, before a sale, if you want to, gift some stock to family members or that type of thing, and really stack that exclusion, because each shareholder can take that exclusion.
All right, one more question on this topic that are not related to 1202, but to that slide. Some clarification on what you said around an S Corp being limited to asset sales only. Maybe explain a little bit further why an S Corp, you didn't, and let me see if I reiterate what you said. It's harder to do a stock sell with an S Corp, right? It's not impossible, but you're more likely going to have to do an asset sell is what I heard. Is that correct?
Yeah, that's right. And it mostly goes back to what we talked about earlier, where there are very strict rules related to who can own an S corporation. Generally, it's U.S. individuals. Certain trusts can also own an S corporation, but you're really limited in the types of owners you can have. And so a lot of times companies are coming in, buyers are coming in, they might already be structured as a C corporation or as a partnership. And so they really can't buy S corporation stock because they're not allowed to be an owner of an S corporation. And so there's some things that you can do to get around that. And generally it involves, selling your assets, or there are certain elections you can make where you can have an asset sale treated as a stock sale for tax purposes. But generally you're just back to basically being an asset sale. Or did I say that backwards, Heather? A stock sale. Yeah. Yeah.
Stock sale so treated as an asset sale. Right.
It's legally treated as a stock sale, but for tax purposes, it's treated as an asset sale. So you're just back to having an asset sale, unless you're selling your S corporation to another individual. Then you can do a stock sale of your S corporation. But generally in the transactions we see, it's not that situation.
And to add a little bit more onto that, the buyer can purchase the S Corp stock. It just means the S election is immediately revoked, right? They can't keep that S election in place if they are not a qualified shareholder or a U.S. individual. So then the company just automatically converts to a C corporation. Most buyers don't want to do that because they don't want to own the entity that may have prior liabilities. They don't know for sure if the S election, was done correctly. They don't want to come in and own that entity with all that prior history as the S Corp. So they would rather buy the assets both for getting the step up in basis, but also to not have any of those carryover, legal liabilities that may be attached to that entity. So they could come and buy the stock. It just means the S Corp election immediately goes away. But generally, buyers are very hesitant to do that. So like Steve said, they either want to buy the assets directly out of the S Corp, or they want some of this other restructuring to happen, drop the assets into a new LLC or something like that they can buy, so that they're not owning that corporation with all the S Corp history from before.
Yeah, and like we mentioned, there's a lot of rules that S Corps have to follow, and so that company that's buying that S corporation kind of inherits all those problems. Like Heather said, like there could be prior issues with their status as an S corporation. And if there could be big liabilities hanging out there just because of how they were operating as an S corporation in the past.
All right, that's everything. Let's move on.
All righty. I think we are on consequences to the buyer in a sale. So when a buyer buys the assets, they're generally able to step up the basis of those assets for the fair value that they purchased them for. So that's where that negotiation comes in on a purchase price allocation, because if there's going to be an asset sale, the buyer is going to want to allocate more of the purchase price to assets that have a shorter life, maybe to inventory or maybe to fixed assets that they can take accelerated depreciation on. But the seller wants to allocate more of the purchase price to that goodwill intangible that's going to have capital gain treatment. And so there's going to be some negotiation there on how that purchase price is allocated, because the buyer is going to want to recover their purchase price a lot quicker through having shorter lived assets, while the seller is going to want it more towards the longer lived assets because they're going to be able to get capital gain treatment. In a stock sale, the buyer doesn't receive a step up in basis of the assets. This is generally going to be your S corp or your C corporation. Those assets are kind of still locked in there at their historical values, and the basis that the buyer has is all locked up. The purchase price is all locked up in their stock, and so they'll have a higher basis amount in their stock. And if they go and sell the stock in the future, they'll have a lower gain that way. But they're not able to recover really any of their purchase price up front through depreciation or any amortization, because you can't depreciate or amortize stock. And the assets inside the company haven't been adjusted for any of that purchase price. In an asset sale, you're able to cherry pick the assets that you want and also the liabilities. You can exclude all of the liabilities of the target and just go in and buy the assets, or if there's other liabilities that you do want to take on, you can do that as well. And so it gives you a lot more freedom if you're the buyer to get the exactly what you want out of the company. With a stock sale, the buyer is going to be buying the whole enchilada. They're going to be getting all the assets, all the liabilities, all the skeletons in the closet. And so there's a lot more risk for the buyer in a stock sale. So there's going to be a lot more due diligence that's going to be involved because of all the potential unknown risks and undisclosed liabilities that might be hanging out there. And a lot of that goes back to what Heather covered with the due diligence checklist, is to make sure that you've covered all your bases and look at those different liabilities that could be hanging out there and know your tax exposure before the buyer does, so that you can either fix things or you have that at least as something in your back pocket, in the back of your mind when you're going into negotiations with the buyer. When you have a stock sale versus asset sale, there's these things called tax attributes. So these are going to be like your net operating losses, R&D credits that you haven't used, different things that are carrying forward within your company. So if you have a stock sale, those tax attributes generally carry over. So the buyer is going to be able to inherit those net operating losses and those R&D tax credits. So those might be something of value to the buyer when you go into negotiations, because they might be able to offset some of their income with those NOLs and R&D credits, or just regular credits that they've purchased as part of purchasing the company. But in an asset sale, none of that stuff carries over to the buyer. And so those just remain with the old company, which can then be used, if you have an asset sale, can be used to offset that gain from the asset sale. Both the NOLs and the R&D and the tax credits can help mitigate some of the tax that is generated from an asset sale within something like a C corporation. And then some legal issues that come up generally when you have a stock sale. A lot of times the buyer wants to do a stock sale because they want to have important key contracts, key customers can come over with that when they're legally buying the stock of the corporation or of the entity. A lot of times those will transfer over, where in an asset sale they might not. And so that might be the reason that even though the buyer is not going to get a step up in basis, they still want to do a stock purchase, because they will get those key contracts and customers from the entity that they're buying. And I think that covers all of this slide. Any questions, any more questions, Stephen, or anything to follow up on that?
Nope, no questions on that topic.
And I think we covered the 1202 stuff already, so I think we're good to move on.
Yeah, I'll just, on the 1202, just to make, I'm not sure if we had said this already, but in an asset sale, so if your C Corp is selling the assets and then immediately liquidates with those proceeds, the proceeds coming out to the owners treated as a redemption distribution upon liquidation of the company, that can actually be excluded under 1202 is in the same way as if the seller had just sold their stock. So that's a nice way where buyers still get, step up in assets, seller, may still be able to have that gain exclusion. So again, in a C Corp setting, that's always something that we want to, if that applies, it's a great exclusion for the seller. Okay, this slide has kind of some random and unrelated information from bullet point to bullet point, but just items that Steve and I wanted to make sure, we threw out there if they're applicable to you, or if you think they might be. It's definitely something to discuss with your tax preparer, just to make sure that you are taking advantage of some of these favorable tax selections that are out there. So in general, businesses are either a cash method taxpayer or an accrual method taxpayer. Probably for your books, you're using accrual just because that's a better reflection of outstanding liabilities as well as receivables. But even if you're using accrual for your books, you can potentially be on a cash method for tax. So in general, if your receivables are higher than your payables, being on a cash method for tax is going to defer that income from your AR until it's collected. So that's something, I mean, Steve actually just mentioned to me yesterday, a client he was looking at where this year that flipped, so that they were going to do a change in method to get on the cash method and just be able to defer that income to the future.
Yeah,
So
it was
generally. Oh, go ahead.
I was going to say they went from about $3.5 million in taxable income down to about a $50,000 loss.
Yeah.
So they're able to, defer tax on $3.5 million of income this year just by making that that changing to a cash method.
Yep, and it's generally something you elect on your first return, but then you can do a change in method later, if circumstances have changed. Another one out there, it's been out there for a while, so it may not be new, but bonus depreciation, or this accelerated depreciation you can use for tax. It's been at 100% for a number of years. Basically saying any assets that are required to be capitalized, you may be using a straight line approach over 3 or 5 or 7 years for your book, but for tax you could take all of that cost as a bonus depreciation deduction in the first year. It's still out there, but starting in 2023 we're on a step down approach due to the 2018 TCJA tax law that was passed. So this year 80% bonus depreciation is available for any new assets acquired. This may be one that is interesting to most people on the call, just being in e-commerce, but the method that you're using to account for inventory changed quite a bit with the 2018 tax law that was passed. Basically, it said that small businesses, which is defined in this sense, right? So different than 1202. There's a bunch of different definitions for small businesses in the code, but in this section, a small business is defined as a business with less than $27 million currently in average gross receipts over the prior 3 years. So if you're in that category, you can treat inventory potentially as non-incidental materials and supplies, allowing for accelerated deduction. There's some coordination that needs to happen with how you're keeping your books under this election, but it is something that is new since 2018. Location of fulfillment centers. So we talked a bit before, if you're using Amazon or a platform like that, you may not have control, right, if they are really deciding where the inventory is being held and shipped from. But if you're using your own warehouses, or you are in control over that, I had a client that moved their fulfillment center from California to Nevada. Nevada doesn't have a state income tax, so that meant all of their shipments that were going to states where they didn't otherwise have nexus were Nevada sourced and were not taxable from a state perspective. So everything's still taxable, from a federal perspective, but going from California to Nevada, that saved 8.84% for them on all those leftover sales that weren't already going to states where they had nexus. So again, if you're in control of where your inventory is being held, just looking at that, or if you're considering a new warehouse location, being aware of what that state rules are and the state rate, it may either be increasing or potentially decreasing your overall effective state rate. Okay, and the last one up here, this is pretty new, the last couple of years, but if you hear the acronym PTET or pass-through entity tax being thrown around, In Utah, this was new for 22, so it's something that many businesses based here have been looking at, but it's coming about in reaction to the 2018 tax law that was passed, where if you have a flow-through entity that is not taxable at the entity level, so an S corporation or a partnership, all of that income flows through to you as the owner. If you're paying all that tax on your individual return, your state taxes have been limited on your itemized deduction schedule, limited to a total of $10,000, which includes property taxes on your home, as well as any state income tax. So with that cap, there's been a lot of state taxes that have not been eligible for federal deduction the last few years. And this started with states with high rates, California, New York, where their residents, this impacted them the most, right, by having this cap on their state tax deduction. So as a workaround, many states have now implemented these pass-through entity tax elections, which say for a partnership or an S corporation, you could elect to pay your state tax at the entity level rather than having your individual owners paying that tax at that level, which gets it off of the individual itemized deduction schedule and out of that $10,000 cap. So say you have an S corporation with $1 million of net income. I'm going to say you're in Utah just to make it easy, and we're going to pretend that Utah's rate is an even 5%. That 5% tax that you're paying before would have been limited, and you wouldn't have lost a deduction for that. But if you choose to pay that at the S corp level, it just reduces your income that's coming through on your K-1 from a federal perspective. So now you just have less income that you're paying on your federal tax return, and then your Utah return is, the net tax is the same. Utah's just received it from your S corp instead of from you as the individual. So states are really, they don't really care either way that is paid, but this is getting around the federal limit and allows for a federal deduction there.
I would just highlight what Heather just talked about. This is a rapidly changing thing that's rolling out throughout the states, and it's a strategy that affects all of your businesses today. So if you haven't had this conversation with your tax accountant, or you need to talk to somebody like Tanner about this is something that's very easy to execute and will give you immediate tax benefit today.
Yeah. And like all state and local income tax issues, every state is different. So in Utah, it's a little bit of a strange rule, but even if you're an accrual method taxpayer, you had to make this payment in cash by the end of the year to get the benefit. California, you have to make an estimate by June of the current year to elect in, and then you true it up when you pay your extension or your return. So just every state is a little bit different. So definitely talk to your tax preparer to make sure you're taking advantage of this. Generally in the resident state of the owners is where that biggest benefit is going to come.
We have a question, Heather. When you're talking about accounting for inventory, this is, I think, a clarification. So accelerated deduction basically means COGS can be, this is the question, does it mean that COGS can be written off upon purchase, not when it is sold? Is that correct?
A portion of that. So generally the actual cost of the inventory item is going to have to still be capitalized, just because inventory under the IRS rules, even if you're on a cash method, is still an item that has to be capitalized. But those extra costs that more the G&A costs that are being allocated to your inventory, those are the types of expenses that potentially could be just deducted as incurred, rather than being allocated to the inventory and tracked and not run through COGS until it's sold.
All right. I think we're good to move on.
Okay, great. I think we are about on our last slide. So as Stephen mentioned last time, we just wanted to hit on the employee retention credit because this is a hot topic Probably everybody is getting emails and calls and LinkedIn messages from firms popping up all over the place saying, you're eligible for the ERC. Have you claimed it yet? So we wanted to touch on the high level, just qualifications, how you qualify for this, what periods it's affected or it is in effect for, just to help clarify maybe some of the confusion that's out there. So the employee retention credit was part of COVID relief legislation passed in 2020. So it's effective for all of 2020 and then for the first 3 quarters of 21. So only through September of 2021. Excuse me. And the credit amounts are different for each period. So for 2020, the maximum credit is $5,000 per employee for the whole year. Sorry, let me get a drink. For 2021, the maximum credit is $7,000 per employee per quarter. So it's much larger. Excuse me, Steve, would you take over?
Me to take over?
Yes, please. Sorry, hopefully I'm back. Just been working through a little bug in my throat. So yes, very much a higher, opportunity in 2021, and it is on a per quarter basis. So you're not having to look at per day or the whole year at a time, but each quarter. Let's see. Okay, so the eligibility. The first bullet point here is definitely the most black and white way to claim this credit. So we're looking at gross receipts, and what the IRS has pegged as the baseline is your activity for 2019. So when you look at any quarter in 2019 and then compare that to the same quarter in either 2020 or 2021, if you have a significant decline in gross receipts, then you qualify for that quarter. Now, significant is defined differently for each year. So for 2020, a significant decline would be a 50% reduction in gross receipts for any quarter as compared to the same quarter in 2019. But for 2021, that threshold was, increased, right? More companies can qualify because that significant decline is defined as just a 20% reduction. Or you can qualify by having a full or partial suspension of your business operations during any of those calendar quarters due to local government orders, affecting travel, meeting spaces, or anything like that during COVID. So that gets to, very local rules in place. So different by state, can even be different by county or different rural or urban areas in a specific state.
And it's important to note too that if it affects you, like say in California, it does apply to your whole business, even if you have operations everywhere. So it's not like it would just be for whatever you were doing in California. It would apply to your whole business. Right.
And so if you can support that for any part of that quarter, then you qualify for the whole quarter to claim that credit, which means you'd be going back to amend your quarterly payroll report to claim those credits. So again, this is outside of income tax, but is a payroll tax credit.
And it's a refundable credit as well. So if you paid less payroll taxes than the amount that you can get back with the credits, then you'll get that amount back as well. And then the other important thing to remember too is that it's basically a reduction in your payroll tax expense. And so the credits are taxable that way because it's reducing your expense, where, there were other programs like the PPP loan where those generally were not taxable once they were forgiven. These will increase your tax, but you still come out ahead since you're getting, a reimbursement of payroll taxes that you paid. And generally you need to go back as in addition to amending your 941s, your payroll tax returns, you likely will need to amend your 2020 and 2021 income tax returns to reflect the reduced amount of taxes, payroll taxes on those returns for the credits that you're going to be getting back. The IRS has said that they need to correspond with when those wages were paid. That's when those credits need to be recognized. And so you really shouldn't be pushing them through when you get the refunds. You need to go back and amend the income tax returns.
Right. And those refunds, we've, seen them take 6 months, 12 months. It may be longer than that. So depending on the size of the claim, the refund can take, quite a long time. This needs to be coordinated with any potential PPP loan that you received. So you can't claim a credit under the Employee Retention Credit Program for the same wages that you got a PPP loan for. Now, a lot of people with their PPP loans, it was just easiest to submit their wage detail on their forgiveness application. There is the opportunity to go back and say, well, were there other qualifying expenses that weren't wages that we could have used to support our PPP forgiveness, which then frees up those wages to be claimed an ERC for. So just keep in mind that needs to be coordinated. Anybody that's looking at an ERC calculation should be asking you for any PPP documentation as well to make sure that there's not double dipping taking place. Our last point on here is just to, watch out for all of those phone calls and emails that you're getting, right? If you believe that your business applies under one of those 2 bullet points, in the eligibility section, just make sure that you're working with a firm that didn't just pop up, 6 months ago. It doesn't only do ERC claims. One that is going to be reputable and be around for any future audit support, if IRS chooses to look at your claim. The statute of limitations on an ERC claim is 5 years, so it is longer than an income tax return. And so you want to be working with, professionals that are still going to be here at least 5 years, or within that 5 years if your claim gets pulled for audit. We have a credit and incentives team that looks at this. There are other reputable firms out there as well, but we've just seen a lot of slimy places that you think are probably not real and scams out there. And this is actually, the IRS has put out warnings about this. In Utah recently, there was a big a criminal case that indicted a firm that was just, fraudulent companies and claiming fraudulent claims. So just make sure that you're vetting, whatever potential provider, if you believe that you have some opportunity here to go back and claim those refunds.
And this, getting back to our due diligence thing, this could be another item that comes up in due diligence that a buyer is going to want to see, that you have good support for any ERC credits that you've claimed, because if they're buying the entity, it could come back on them. Mm-hmm. And so it's something, to even keep in mind for something like that.
Okay, I'm going to flip to our last slide, which just has our contact info. But
I think
any other questions?
Yeah, just one point. As to summarize the ERC, I'd say definitely take a look at it, but be careful with who you work with. A lot of the people that are out there advertising hard are not going to be here in 6 months, and if you run into any issues with how it was prepared, you're up a creek. So be wise is what I would say on that credit. All right, let's wrap it up. So if you want to talk to Heather or Steve, we got your contact information here. Any final questions from the audience before we wrap this up? All right, we don't have any questions. So thank you again for joining us for this second part, Heather and Steve. Lots of great information. Hopefully it's been beneficial for those that have attended and or who will be watching this later. Again, thank you for attending, and we'll talk to you later.
Thank you.
Thanks.